A $1.50 hot dog and soda combo has cost the same since 1985. While inflation tripled. While Coke raised prices 15 times. Costco refused. And the man who ran it? He once threatened to kill the executive who suggested raising it. Most investors look at Costco and see a boring discount warehouse. Thin margins. Stacks of paper towels. Free samples. They miss the genius hiding in plain sight. Because Costco isn't really a retailer. It's something far more interesting. And once you understand what it actually is, you'll never look at low-margin businesses the same way again. So let's talk about how a company that deliberately limits its own profits became a $400 billion empire that even Warren Buffett admired. Walmart's gross margin? Around 24%. Target? Closer to 28%. Costco? Just 11%. By every traditional retail metric, this should be a disaster. But here's the twist. Costco caps its markup. Branded items get marked up no more than 14%. Their own Kirkland brand? Capped at 15%. Most retailers mark up products by 25 to 50% or more. Costco refuses. So how does it make money? Membership fees. As of 2024, a basic Gold Star membership runs $65 a year. The executive tier, $130. And get this, the company pulls in roughly $4.8 billion a year just from those fees. Here's the part most people miss. That $4.8 billion? It's almost pure profit. It flows straight to the bottom line. Which means, the actual retail business doesn't really need to make money. The fees do that job already. It's a complete inversion of how retail normally works. Walmart sells you stuff to make a profit. Costco breaks even on stuff to keep you paying the membership. And that membership renewal rate? Around 93% in the US and Canada. Year after year. Sound familiar? It should. Because this is exactly the kind of moat Warren Buffett spent his career hunting for. But the real magic is what they do with those razor-thin margins. Back to that hot dog. The story goes, former CEO Craig Jelinek once told co-founder Jim Sinegal that the food court was losing money. They needed to raise the price. Sinegal's reply, according to Jelinek himself? If you raise the effing hot dog price, I will kill you. He was joking. Mostly. But here's why it mattered. That $1.50 combo isn't just food. It's a promise. Walk into any Costco anywhere in America, you know exactly what you'll pay. The same price for 41 years and counting. It's what the great investor Charlie Munger called a trust quotient. When customers really know that you'll never gouge them, they stop checking your prices. They just buy. Because they trust you. The rotisserie chicken? $4.99. Same since 2009. Costco actually built its own $450 million chicken processing plant in Nebraska, just to keep that price stable. They lose money on it. On purpose. Why? Because the chicken brings you in. The hot dog keeps you happy. The $2 cho reminds you, this place treats you fairly. And once you're inside? You spend an average of $114 per visit. On things with healthy margins. The loss leaders aren't losses. They're advertising. Cheaper and far more effective than any commercial. But the deepest lesson, the one investors took decades to fully appreciate, came from a man who watched it all unfold from inside the boardroom. Charlie Munger joined Costco's board in 1997. He stayed there until his death in 2023. 26 years. He once said, and I'm paraphrasing, that Costco was one of the most admirable capitalistic institutions in the world. He bought shares personally. He talked about it constantly at Berkshire Hathaway meetings. And the numbers tell you why. Costco went public in December 1985 at $10 a share. By 2026, the stock trades for around $900. That's a return of roughly 90 times your money. Not counting dividends. Not counting the special cash dividends Costco occasionally pays out. A $10,000 investment at the IPO? Worth roughly $900,000 today. From a company that deliberately limits its own profits. That's the paradox at the heart of value investing. The businesses that obsess over short-term profit often fade. The ones that obsess over the customer compound for decades. Buffett himself owned Costco shares through Berkshire for years before exiting around 2020. But Munger? He held to the end. He understood what most analysts couldn't model in a spreadsheet. Here's the principle. The strongest moats aren't built by squeezing customers. They're built by treating them so well, they never want to leave. Costco gives up margin to gain something far more valuable. Trust. Loyalty. A membership renewal rate that looks more like a subscription business than a retailer. Price is what you pay. Value is what you get. Costco built an empire by making sure their customers always got more value than they paid for. That's not charity. That's the most ruthless long-term strategy in retail. So here's my question for you. What other companies do you know that play the long game like this? The ones that almost seem to leave money on the table, but win the decade? Drop your favorites in the comments. I read every one. And if this changed how you think about low-margin businesses, hit subscribe. Tomorrow we're tackling a market crash that taught Buffett everything he knows about fear. This is educational content, not financial advice. Always do your own research before investing.